Ladies and gentlemen, the markets were crazy today, and here in this video, I'm going to put it all into context, give you the news that you need to know. And we're going to talk about tomorrow's reciprocal tariff date and the reciprocal tariff threats that we're hearing about today from Mexico, Canada, and the EU. And why ultimately, yeah, this can be a big deal, but it's not the big catalyst of this week that you may think it is. And I'll explain that in this video. But first, we need to start with the economic data that came out this morning. Now, we did have some economic data today as well with ISM manufacturing PMIs. They came in at 49 versus estimates of 49.5. So came in a little bit weaker than expected. ISM manufacturing employment came in at 44.7. Well off the estimate of 47.5. Construction spending month over month came in positive 0.7% versus estimates of 0.3%. So that beat. ISM manufacturing new orders came in at 45.2 versus estimates of 48.5. And prices in the manufacturing sector came in at 69.4 versus estimates of 65. So prices up, employment down, new orders down. That does kind of look stagflationary, although markets don't really care too much about the manufacturing PMIs. They've been bad for a really long time. So again, it's not a big shocker when they're bad, or really markets don't care because manufacturing is like 20% of the economy. So it's just not a big enough chunk of the economy to really make a big difference for inflation or for, GDP. Now, JOLTS job openings came in lower than expected. Last month, you were at 7.762 million. We were expecting 7.63 million. You came in at 7.568 million. So you came in a fair bit below expectations, okay? It's not the end of the world. It's not too bad, but it's not a great sign for the labor market either. Now, the big data this week, even forget the reciprocal tariffs coming tomorrow. The big data is your jobs report. It is your unemployment rate. It is the speech from Fed Jerome Powell on Friday. We'll talk about this a little bit more in the next video, but that's what is really going to be the big driver of at least the end of this week. So anything can happen between now and Friday, even if markets rally or sell off into Friday. It doesn't really matter because Friday is going to give you the biggest move. Now, JOLTS job quits came in a little bit lower than expected at 3.195 million versus estimates of 3.2 million. And the RCM TIPP Economic Optimism Index came in at 49.1 versus estimates of 50.1. Dallas Fed Services Index came in at negative 11.3. The estimate was positive 5, so that was really bad. Dallas Fed Services Revenues Index came in at 1.3 versus estimates of 7. So that was also really bad. And you can see today, just looking at the broader indexes, the Dow is up 0.1%, S&P is up 0.3%, NASDAQ up 0.72%, Russell 2000 up 1/3%, the VIX is down 1.5% today to 21.94, and bonds are down a lot as well. 10-year Treasury yields are down almost 9 basis points to now the lowest level you have been at since the election, coming in at 4.15%. So this seems partly due to some of the tariffs that could be coming out tomorrow. And there's, some reports suggesting a roughly 20% tariff on most imports. I think Wall Street's saying that's going to be bad for the economy, that it's going to be worse for economic growth than it is, an upside pressure for inflation. And I think people are going out and buying the bonds for that. But I also think you just ended Q1 yesterday. Now you've started Q2. And I think people are saying bonds offer a really good risk reward here for Q2, especially if the economy weakens. So as people kind of reshuffled their portfolios yesterday, I think they're saying Q2 bonds are a pretty good bet in this market. And I think that's partly why bond yields, 10-year treasury yields, are down almost 9 basis points today. That's a huge drop on, data that mainly came in line with expectations. So it's not about the data. It's about what Wall Street is seeing for Q2, which lower bond yields, lower economic growth. That's not exactly great for stocks. So it's a little bit of a red flag, in my opinion. Mexico's President Sheinbaum says the response to U.S. tariffs will come on April 3rd. So they're planning reciprocal tariffs. And the head of the EU here says many Europeans feel disheartened by the new U.S. tariffs. Europe didn't start this, but we have what we need: the biggest single market, the leverage to negotiate, the means to strike back. We'll defend our interests. She concludes this speech by saying, let's be clear, we didn't start this. If needed, we have a strong retaliation plan and we will use it. And this headline here says the EU is considering targeting big US tech firms with regulations in response to Trump's tariffs. Canada's Prime Minister Carney says we are going to be very deliberate in terms of the measures we take to fight for Canada. And Carney says that Canada will retaliate with tariffs if the US applies tariffs on Wednesday. And Canada's Prime Minister Carney says Trade Minister LeBlanc is having regular talks with US Commerce Secretary Lutnick. And Donald Trump will be delivering remarks in the Rose Garden at 4 p.m. on Wednesday. So it looks like the tariffs are going to come after the bell tomorrow, like after the markets close tomorrow. So that'll get interesting. The Mexican President Sheinbaum says there are more lists of names of alleged drug traffickers for extradition to the U.S. Mexico is willing to cooperate. The CNN Fear and Greed Index today is at 19. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand in extreme fear. And junk bond demand also in fear. The percent of stocks trading above their 50-day moving average sitting at about 25% today, actually positive, up 0.22%. So that's good, but this is not a great indication of what's coming next for markets anymore. I mean, we've been in a weak place really since September, October of 2024, and it just hasn't gotten any better. What will be interesting coming out on Thursday is a new AI investor sentiment survey. We did see bullish investors jump from 2 weeks ago, but markets hit a new low of this correction yesterday. Do you see those bullish investors dial back a bit and fall lower again, or does it remain relatively stable? And what that'll do is kind of reset some of your sentiment metrics, where it'll kind of show people are getting now used to lower levels, and people can get bullish at lower levels. That obviously can set you up for further downside as people turn from bullish again to bearish. A lot of the argument that some of your bulls have made out there is sentiment is so negative. And sure, you see that in some sentiment surveys like this AAII investor sentiment survey, but you don't see that in the VIX. You don't really see that in price action in the markets. People are not that bearish out there. Like XLP, I know, consumer staples, that's kind of a recession trade in and of itself, but it's still near all-time highs. Any recession we've ever went into, XLP has also gotten completely destroyed, right? 08, 09, COVID, doesn't matter. Like during an actual recession, consumer staples will also get wrecked. Tech will get wrecked. Everything. Normally, you don't see a bid to consumer staples even during a recession. Or going into one, you can a little bit as somewhat a, defensive trade. But it's not a sign of mass fear out there. Now, I think it's very important that we all understand this. A trade war is bad for the economy, okay? Some people think it's bad for inflation. It depends how far things go. Like if we go into a recession, are we going to have this inflation problem? Probably not, okay? We don't know how far this trade war is going to go. Unfortunately, I don't see Trump backing down and, looking like the guy that backed down when, the going got tough. So I'm hesitant to say that there's going to be just deals struck left and right, that this is all just going to be over with relatively soon. So the question is, how long does this last for, and how much damage is done to the economy? To a certain extent, the damage may already be done. Q1 GDP is tracking at negative 0.5%. So of course, coming tomorrow, markets are going to move based on expectations. They always do. Okay, if Wall Street is expecting a 15% tariff and we get a 20% tariff, that's bad. Stocks probably fall. If we're expecting a 20% tariff and we get a 20% tariff, that may be a more positive, favorable outcome coming tomorrow. But the fact of the matter is, it's more tariffs. It's escalation of the trade war, and it's bad for the economy. Tomorrow, the economic outlook is going to look worse than it does today. In other words, no matter if markets are up 2% or down 2%, that's the fact, okay? So I actually don't think it's the big catalyst. Short term, of course. Tomorrow, could it be a green day off of, smaller than expected tariffs? Of course. But it's really all about the economy at this point. And our economic data coming out on Friday, that's really the big catalyst. Now, tomorrow, you don't have much for economic data. You do have the ADP employment change. Thursday, you're going to have ISM services PMIs and exports, imports, balance of trade. That does feed into the Q1 GDP report. And we'll see, because there's still more data to come for Q1. But so far, it looks like it's going to be negative. Friday, April 4th, we have the unemployment rate. You're expecting that to move up from 4.1% to 4.2%. Non-farm payrolls are expected between 130,000 and 80,000. Anything higher than 130,000 is going to be seen as positive. Anything lower than 80,000 is going to be seen as negative. Okay. That's the big catalyst of this week. Is the labor market weakening? That's what we really want to know. And that's what will drive the next leg potentially down for markets. You also have a speech from Fed Jerome Powell Friday at 10:25 in the morning. Now, this is going to be after the jobs report, the unemployment rate. It's going to be after reciprocal tariffs coming tomorrow. The Fed's going to have a little bit more information to go off of. I'm not expecting a huge pivot from Powell, but if the jobs report is good or bad coming Friday, I do think Powell will acknowledge that. If it's bad, he may be a little bit more dovish. If it's a good jobs report, he may be a little bit more in that wait and see approach. And I also think that will be a big catalyst by this Friday. So believe it or not, I think Friday is a much more important day than tomorrow, even though tomorrow is also going to be volatile. And if we look at the markets from a technical perspective, yesterday we hit a new low of this correction at 546. It looks like a lot of demand came in around that 300-day moving average, which is currently at $549 flat. That's the level we want to be watching for throughout the rest of this week. And then your 200-day moving average to the upside. If we can get above that, into Friday, if Friday's a good day and we close above your 200-day moving average, that's a great sign. Now, if we fall below your 300-day moving average by the end of this week, that's not great, because that sets you up for downside as low as, $500 on the SPY, which in all reality is where you were roughly on the low of the flash crash on August 5th. So it hasn't been that long, relatively speaking, since you were at those levels. And that's what kind of downside is opened up if you get below that 300-day moving average. So I'm still overall cautious and, if you will, bearish on our markets, because I think the economy will get worse. And I think ultimately, when you boil it down tomorrow, the economic outlook is going to get worse. It's not going to get better, even if tariffs are smaller than expected, right? So from that perspective, I'm cautious here. I'm putting some money to work selectively in different stocks, because you got to have exposure to this market. I mean, anything can happen. You could rip back to new all-time highs, right? That is possible, okay? and you don't want to miss that. But at the same time, you want to have as much cash as possible ready to buy the dip when that larger dip does come. And as I've said before here on this channel, if you get back to 500 on the SPY, that's where I think the risk reward is at kind of an equilibrium, where at 500 on the SPY, you have roughly 20% downside down to 400 on the SPY, and you have roughly 20% upside back to 600 on the SPY. That is where I feel more comfortable taking out, more long positions in this market. But at this level, I think you just got to be patient. We're going through the motions of what could be the start of a bear market or something that kind of feels like a bear market. And you got to be patient here in markets like this. So let me know your thoughts on all of this information down below in the comment section. What is your expectation for tomorrow? It's going to be crazy, to say the least. And again, those tariff announcements are probably going to come out at 4 when Trump speaks in the Rose Garden. But we could get some headlines before that. That's what tends to happen. So you guys have a great rest of your day, and I will see you in the next one.